There's a lot of excitement around building fourplexes in Toronto these days, and it's because it's not just wishful thinking anymore. It's quickly becoming a reality, and the numbers are adding up much better than before. Now, if you're curious in terms of why developers are shifting their focus from luxury homes to fourplex builds and why our own clients are now looking into this, what is involved and how the numbers work, get ready because we're diving deep into this in this video. If you're new here, we're all about helping you make better real estate investing decisions in Toronto. Don't forget to like and subscribe if you enjoy this content. Now, let's dive in. Let's talk about why there's a lot more buzz around fourplex builds lately. First of all, it's now actually doable thanks to zoning changes in Toronto. Last year, in 2023, Toronto gave the thumbs up to new zoning rules letting every house in the city to have up to 4 units plus a backyard house. Now, another big change is parking requirements. These got tossed out, and this is a huge thing because it actually frees up space on properties, and this move is especially helpful for smaller lots in Toronto, making it actually feasible to fit in 4 units without parking requirements. Now, next, the cost of construction is becoming more appealing too. Development charges are usually around $50,000 per unit, but now it is waived for up to 4 units. And if you build an extra backyard house as the 5th unit, then the development charge for that house can be postponed for 20 years, which is another big thing. Now, in terms of financing, you can aim for a down payment as low as 20% when you make this purchase of a single family home. You can fund the construction with a private loan, but typically a lot of our clients are actually funding with cash to reduce their risk. And once you complete the build, you would have various exit strategies. Sure, you can sell and cash out, but you can also rent out the multiplex and then refinance it, which sets this approach apart from developers' traditional approach to build luxury homes for sale. When you do this, developers can now enjoy the benefits of long-term appreciation and rental income long after putting in the effort of initially building the home. Then, when it comes to refinancing, yes, you can still secure residential conventional financing for 4 and 5 units with a major bank. Now, alternatively, you can opt for CMHC's MLI Select financing if you do have 5 or more units and qualify for lower interest rates, a higher loan to value ratio, and a longer amortization period. Now, I won't go into this too much in this video, but you can check out this other video right here if you want more details on this program. Now, another big thing that's attracting clients to new builds is the fact that new units are not subject to rent controls. Now, with market rents coming up very quickly because of our housing crisis and the fact that the gap between existing rents and market rents are expected to widen because of this, non-rent controlled units look even more attractive when you factor this in. On top of this, it's much easier to figure out how much a property is worth after you build it when it comes to a rental property. Luxury homes can be worth a lot when the market is good, but when there is a recession, their value can drop dramatically. So basically, luxury homes are more affected by emotions and swing a lot more, which makes them a little bit higher risk. With rental units, it's pretty simple. What you would look at is the net rents and compare that to market cap rates, and then you can get the value from that. So it is easier to predict how much your investment will make, and this ends up making your project a lot less risky. Next, let's talk about returns. The returns often add up pretty well, which is why more and more clients are jumping on board with this approach. However, this is not for everyone, naturally. It requires a significant amount of capital upfront, and it will be tied up for a couple of years. A lot of our clients are actually financing this project with cash, like I mentioned before, and opting for a lower loan-to-value ratio to lower their investment risk. Now, on top of investment risk, you also need to be ready to take on the extra risks of development because this is a huge undertaking. You're essentially demolishing a house and converting it into a mini apartment complex. Now, if you do have the capital and you are comfortable with this high development risk, let's take a closer look at why our clients are heading in this direction with the numbers. A typical starting point in Toronto is to buy a small house for about $1 million, and then we would top it up and turn it into a fourplex, which might cost another $1 million in construction costs. After it's all set up, the total monthly rent for all 4 units in this fourplex might be around $15,000. Once we subtract operating expenses, which we factor in to be around 15%, this leaves us with around $13,000 per month or $153,000 per year in net operating income. Now, using a conservative estimate of 5% cap rate for multifamily homes, the post-construction value of this property jumps up to $3 million. And that translates to a $1 million value add gain from doing this fourplex build. Now, instead of selling to cash out, let's say we refinance a property with a conventional residential mortgage, pulling out 80%, which is $2.4 million, which ends up covering our initial investment and leaves us with an extra $1.2 million cash. And when we do this, rents can still cover expenses and the mortgage payments, so we end up comfortably continuing to build equity with each mortgage payment and benefit from the property's long-term market appreciation as well. Now, if we also build a backyard house and then refinance it all together with a CMHC MLI Select mortgage, we might get even better terms like a lower interest rate, longer amortization periods, and the ability to take out even more cash so that you can fund future projects. Now, let's take it one more step further. If building one fourplex makes sense financially, wouldn't it even make more sense to divide a bigger lot and build 2 fourplexes on the same lot? Well, for one, finding a wide enough lot in Toronto is pretty rare for starters. Sure, the potential returns could be higher. Let's say the lot might be close to 50% more, but once you break it down per unit, it becomes 25% less per unit. You still earn the same amount of rent per fourplex, so you can potentially get better overall returns. But there are some things to think about. Even if you find the right lot, you will need a lot more money for a project like this. You might end up needing a lower loan-to-value ratio because of the higher purchase price if you're tapped out on your qualifications. Plus, building 2 fourplexes mean you need double the construction money. And here's another thing. There's a lot more uncertainty with this as well, which means more risk. There are way more unknowns about severing the lot, the extra holding costs involved, and the extra charges involved in the process. So if you are new to this, it might be safer to start with just one fourplex build to increase your chances for your project success, which is honestly already really amazing. If you're interested in learning more about this, our team is ready to help. We've been helping more and more clients find properties perfect for building multiplexes in Toronto lately, and we know what to look for to make sure you get the best returns with the least amount of risk. Plus, we have architects who can check your plans to make sure they're doable, can help you with rents, cash flows, and valuations, and connect you with reliable trades and builders so that you can build your A team more successfully. If you want to discuss your private real estate situation with us, just head over to this link to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.